This is not a drill, people. The Oracle of Omaha is preparing for what could be the biggest buying opportunity since 2008. And today I'm going to reveal exactly what he's buying and why this play could return over 420%. But here's the thing. Most investors will completely miss this opportunity because they're too busy watching their portfolios bleed red. If you stay until the end of this video, you'll know exactly how to position yourself before the masses figure out what's happening. I'm Daniel Brooks, and this is the channel where we break down the smartest money moves from billionaire investors so you can learn how to build real wealth. Before we dive deep into Buffett's secret strategy, do me a quick favor and smash that like button and hit subscribe. We're building a community of smart investors here, and I don't want you to miss the next big opportunity we uncover together. Now let me show you something that will blow your mind. Warren Buffett has been selling stocks like crazy for the past several quarters. He dumped billions of dollars worth of Apple, Bank of America, and several other major holdings. And while mainstream media was calling him crazy, while so-called experts were saying he'd lost his touch, Buffett was quietly building up a cash position that now exceeds $330 billion. Let me put that into perspective for you. That's more cash than the entire market capitalization of companies like Netflix or AMD. That's more money sitting on the sidelines than most hedge funds manage in their entire existence. And here's what nobody is talking about. Buffett doesn't hold cash because he's scared. He holds cash because he sees opportunity coming. You see, throughout his entire career, Buffett has followed one simple pattern that has made him one of the richest people on the planet. He waits patiently while others are greedy, and then he buys aggressively when others are fearful. He did this in 1974 when the market crashed and everyone was running for the exits. He called it like shooting fish in a barrel. He did this again in 2008 when he invested $5 billion in Goldman Sachs during the financial crisis. That single investment made him over $3 billion in profit. And now, all the signs suggest he's about to do it again. But this time, on a scale we've never seen before. Let me explain what I mean by the $7 trillion crash. Right now, the stock market is trading at some of the highest valuations in history. The Shiller P/E ratio, which measures how expensive stocks are compared to their long-term earnings, is flashing warning signs that we've only seen twice before. Once during the dot-com bubble, and once right before the 2008 crash. When you add up the total market capitalization that's at risk if we return to normal valuations, we're talking about a potential drop of $7 trillion or more. That's not fear-mongering. That's just basic math based on historical averages. Now, here's where it gets really interesting. Buffett has been quietly increasing his position in one specific sector that historically performs incredibly well during market downturns. And based on his track record, this sector has the potential to deliver returns of over 400% when the dust settles. But before I reveal what that sector is, I need you to understand why Buffett's timing is almost always perfect. You see, most investors think they can time the market by watching charts and reading news headlines. But Buffett plays a completely different game. He doesn't try to predict when the market will crash. Instead, he positions himself to take advantage of crashes whenever they happen. This is a crucial difference that most people miss. Buffett knows that he can't predict the future, but he can prepare for it. And right now, his preparation is louder than any words he could possibly say. In his most recent shareholder letter, Buffett made a statement that sent chills down my spine. He said that wonderful opportunities come along rarely, and when they do, you need to be ready to act. He compared it to being a baseball batter who doesn't have to swing at every pitch. You can wait for the perfect pitch, the one right in your sweet spot, and then swing with everything you've got. The problem is, most investors are swinging at every pitch, depleting their cash and their patience long before the real opportunity arrives. So what is the 420% play that Buffett is positioning for? Based on my research and analysis of Berkshire Hathaway's recent moves, I believe Buffett is betting big on three specific areas. First, he's loading up on short-term treasury bills. Right now, Berkshire holds over $150 billion in treasury bills that are earning around 5% annually with virtually zero risk. This means Buffett is getting paid to wait. He's earning billions of dollars in interest while he patiently waits for stock prices to fall. When they do fall, he'll have an absolutely massive war chest ready to deploy. Second, and this is where it gets really exciting, Buffett has been quietly increasing his exposure to the energy sector. He's been buying shares of Occidental Petroleum for years now, and he shows no signs of stopping. Why energy? Because no matter what happens in the economy, people still need to heat their homes, drive their cars, and power their businesses. Energy is the lifeblood of civilization. And during market crashes, energy companies with strong balance sheets tend to hold up better than most other sectors. Plus, when the recovery comes, energy stocks often lead the way higher. Before I reveal the third piece of Buffett's strategy, I need you to do something critical. If you're getting value from this breakdown of how billionaires think, hit that subscribe button right now and turn on notifications. We're about to dive into the most profitable part of Buffett's playbook, the part that made him 400% returns in 2008, and you don't want to miss it. Drop a comment below. Are you building cash like Buffett or staying fully invested? I want to know where you stand. Now let's talk about the lender of last resort strategy. But here's the third piece of the puzzle that almost nobody is talking about. Buffett is also positioning Berkshire to be a lender of last resort during the next crisis. During 2008, when banks were collapsing and credit markets were frozen, Buffett stepped in and provided emergency capital to companies like Goldman Sachs and General Electric. In exchange, he received preferred shares with massive dividend yields and warrants that allowed him to buy common stock at huge discounts. These deals made Berkshire billions of dollars in profit. The Goldman Sachs deal alone generated returns of over 400% when you factor in the dividends and the stock appreciation from the warrants. Now think about this. With over $300 billion in cash, Buffett is in an even stronger position today than he was in 2008. When the next crisis hits, and trust me, it will hit eventually, because that's just how markets work, Buffett will be able to write checks that no other investor can match. He'll be able to rescue major corporations in exchange for sweetheart deals that guarantee massive returns. This is the 420% play that I believe Buffett is setting up. Let me walk you through how this could work in practice. Imagine a major company, let's call it Company X, gets into trouble during the next market downturn. Maybe their stock drops 50% and they can't access credit markets to fund their operations. Buffett steps in and offers them $10 billion in emergency capital. In exchange, he gets preferred shares that pay a 10% annual dividend, plus warrants to buy the common stock at a price that's 50% below the current market value. When the market recovers and Company X's stock goes back to its previous highs and beyond, Buffett's total return could easily exceed 400%. This is exactly what happened with Goldman Sachs, and there's no reason to think it won't happen again. Now, I know some of you watching are probably thinking, okay, this is great for Buffett, but how does this help me? I don't have $300 billion sitting around. And that's a fair point. But here's the thing. You don't need billions of dollars to follow Buffett's strategy. You just need to understand the principles behind what he's doing and apply them to your own situation. Principle number 1. Always keep some cash on the sidelines. I know it's tempting to be fully invested all the time, especially when the market is going up. But having cash available when opportunities arise is one of the biggest advantages you can give yourself as an investor. Even if it's just 10% or 20% of your portfolio, that cash can be the difference between watching a crash happen and actually profiting from it. Principle number 2. Focus on quality companies with strong balance sheets. Buffett doesn't buy junk. He buys businesses that generate consistent cash flow, have competitive advantages, and are run by competent managers. During market crashes, quality companies recover faster and often come out stronger on the other side. So instead of chasing speculative stocks, build a watch list of quality companies that you'd love to own at the right price. Principle number 3. Be patient. This might be the hardest principle of all, but it's absolutely crucial. Buffett has been building his cash position for years, not weeks or months. He's willing to sacrifice short-term returns in exchange for the potential of massive long-term gains. Most investors can't do this because they're too focused on what's happening today. But if you can train yourself to think in years instead of days, you'll have a huge advantage over the competition. We talk a lot on this channel about the psychology of investing because honestly, that's where most people fail. They know what they should do, but their emotions get in the way. They panic sell at the bottom and panic buy at the top. They chase hot stocks after they've already made their big moves, They give up on great companies just because the stock price went down for a few months. Buffett avoids all of these mistakes by sticking to his principles no matter what the market is doing. Let me share something really important with you. In 2008, when the market was crashing and everyone was certain the world was ending, Buffett wrote an op-ed in the New York Times titled, "Buy American I Am." In that article, he explained that he was moving his personal money out of treasury bonds and into American stocks. He said that, "If you wait for the robins, spring will be over." He was telling everyone exactly what he was doing, and yet most people were too scared to follow him. Those who did follow his advice and bought quality stocks during the crash made life-changing money in the years that followed. Fast forward to today, and we're seeing the same setup happening again. Buffett isn't writing op-eds this time, but his actions are speaking louder than words ever could. He's selling overvalued stocks, building cash, and positioning himself for the next big opportunity. The question is, will you be ready when it comes? Now, I want to address something I see in the comments all the time, but first, if you found this breakdown valuable, share it with someone who needs to hear this message. There are so many people about to get caught off guard by what's coming, and maybe this video can help them prepare. Hit that share button right now and drop a comment. What do you think about Buffett's current strategy? Do you think the crash is coming soon, or do you think the market has more room to run? I read every single comment. Now let's talk about the sectors Buffett is avoiding. I also want to talk briefly about the sectors that Buffett is avoiding because this tells us just as much as the sectors he's buying. Over the past few years, Buffett has been trimming his positions in technology stocks, including his massive stake in Apple. Now, Apple is still Berkshire's largest holding, but it's much smaller than it used to be. This suggests that Buffett thinks tech stocks are overvalued relative to other opportunities. He's also been selling bank stocks, which could indicate concerns about the financial sector heading into a potential recession. On the flip side, Buffett has been adding to his positions in energy, particularly oil and gas producers. He's also maintained his large stakes in insurance companies, which is interesting because insurance companies generate huge amounts of cash that can be deployed during market downturns. This all fits the pattern of someone who's preparing for volatility and looking to take advantage of lower prices when they arrive. Let me give you some specific numbers to think about. If the market drops 30% from current levels, which is not at all unreasonable based on historical patterns, that would represent a loss of about $7 trillion in total market value. But for investors with cash on the sidelines, a 30% drop would represent a massive buying opportunity. You could buy the same shares of great companies for 70 cents on the dollar. And when the market eventually recovers, which it always does, you'd be looking at gains of 40% or more just to get back to even. If you then hold for several more years as the market continues to grow, your total returns could easily exceed 400%. This is the math that Buffett is doing in his head every single day. He's not thinking about what the stock market will do tomorrow or next week. He's thinking about, where will these companies be in 10 or 20 years, and what's the best price I can pay for them today? This long-term thinking is what separates him from 99% of other investors. Remember, the goal here on this channel is not to scare you or make you panic. The goal is to help you think like the best investors in the world so you can make smarter decisions with your money. Buffett is not scared of what's coming. He's excited about it because he knows that market crashes create the best opportunities to build wealth. And if you position yourself correctly, you can be excited too. Let me leave you with this thought. Buffett isn't sitting completely in cash. Berkshire still owns massive stakes in incredible businesses like Coca-Cola, American Express, and the entire BNSF Railroad. These are companies that generate billions of dollars in cash flow year after year, regardless of what the stock market is doing. So even while Buffett is building his cash position, he's still collecting dividends and watching his businesses grow. This is the beauty of owning quality companies. They pay you to wait. The crash is coming. We don't know when, but we know it's inevitable. And when it does come, the investors who prepared, who built cash, who identified quality companies, who stayed patient, those investors will make generational wealth. The question is, which side will you be on? Will you be the investor who panics and sells at the bottom? Or will you be the investor who buys when there's blood in the streets? Buffett has already made his choice. He's ready with $330 billion in firepower. The real question is, are you ready? Thank you so much for watching all the way to the end. That tells me you're serious about your financial future, and I really appreciate you being here. Make sure you subscribe if you haven't already, and hit that bell icon so you never miss a video. I'll see you in the next one. Stay smart, stay patient, and remember, the best opportunities come when everyone else is running scared. I'm Daniel Brooks, and this is how you build real wealth.